The expense ratio is a term you'll often hear in investing, especially when dealing with mutual funds or exchange-traded funds, ETFs. Simply put, it's the annual fee that an investment fund charges its investors to cover the costs of managing the fund. This fee is expressed as a percentage of the total assets you have invested. For example, if you invest $10,000 in a mutual fund with an expense ratio of 1%, you'll pay $100 per year in fees. This amount is automatically deducted from your investment returns, so you won't receive a separate bill. It's taken out before you see your returns. The expense ratio covers various costs like fund management, administrative expenses, marketing, and other operational costs. It's how fund managers and companies get paid for running the fund and making investment decisions on your behalf. Now, let's talk about how the expense ratio impacts your investment. While 1% might not sound like a lot, it can add up over time, especially with large investments or long-term holdings. High expense ratios can eat into your returns, meaning you keep less of the money your investments earn. For example, imagine two funds, Fund A and Fund B. Both earn a 7% annual return, but Fund A has an expense ratio of 0.5%, while Fund B has an expense ratio of 1.5%. Over 1 year, the difference might not seem huge, but over 20 or 30 years, the higher expense ratio can significantly reduce the amount of money you earn. This is why paying attention to the expense ratio is crucial when choosing where to invest. Expense ratios vary depending on the type of fund. Actively managed funds, where professional fund managers make frequent decisions about buying and selling investments, often have higher expense ratios, typically between 0.5% and 2%. This is because they involve more work and research. In contrast, passively managed funds, like index funds or ETFs, usually have lower expense ratios, often below 0.5% and sometimes as low as 0.03%. These funds track a specific index, like the S&P 500, and don't require as much hands-on management, which reduces their costs. Here's a simple way to think about it. Imagine you're choosing between two grocery stores. One has higher prices, but claims to offer more personalized service and specialty products, while the other has lower prices because it's more straightforward and sticks to the basics. The higher-priced store is like an actively managed fund, and the lower-priced one is like a passive index fund. The choice depends on what you value more, potentially better service or saving money. So, how do you decide if a fund's expense ratio is worth it? Consider the fund's performance. If an actively managed fund consistently outperforms its benchmark, the higher expense ratio might be justified. But if it doesn't, you might be better off with a lower-cost passive fund. Another factor to consider is how long you plan to invest. For short-term investments, the impact of an expense ratio might be smaller. But for long-term investments, even a small difference in the expense ratio can make a big difference in your total returns due to compounding. By understanding and comparing expense ratios, you can make more informed decisions about your investments and keep more of your hard-earned money growing over time. Remember, every percentage point counts when it comes to your financial future.